Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups. Brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets, what is about to happen in the week ahead. Also, I'll just let you have a quick look at the disclaimer. I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the normal format, so we'll just check out what's happening in markets as we kick off this week. We'll briefly look at gold, which touched made another record high. And is up over 1.1% today already. Then we'll look at stocks and some of the major US indices. We'll then go into last week's main events. Obviously, a bunch of major central banks with the Fed, Bank of Canada, Bank of England, Bank of Japan, all meeting. So we'll just go through those, look at the implications for those. And also then the currencies associated, so dollar CAD, sterling against the dollar cable, dollar yen, and of course, we'll look at the DXY chart as well. So that's the dollar index against a basket of 6 other currencies. And then we'll look at this week and what's on the calendar for this week. PMI data, some US core PCE data, and also actually Australian inflation data and a Swiss National Bank, which we don't look at much, but hopefully we'll have time just to have a quick look at that. So we'll look at dollar Swiss, Aussie dollar, and euro dollar as well, with the PMIs coming up tomorrow. Okay, there's the list really of what we want to get through in the next 30 minutes or so. First up, really, how markets are trading currently. APAC stocks, Asian stocks, they were mixed really after Chinese markets failed to benefit from the phone call from President Trump and Chinese President Xi on Friday, with some citing a lack of concrete progress. Interesting, that call, and we'll touch upon that shortly. US lawmakers, they face a deadline of September 30 to pass a funding bill to avoid a government shutdown. Members of the Senate are not scheduled to return to Washington until September 29, and House lawmakers are not due to return until October 7, according to NBC. Estonia triggered the NATO Article 4 after 3 Russian MiG-31 jets entered into its airspace on Friday, while Germany scrambled fighter jets to track a Russian plane over the Baltic Sea over the weekend. Nothing really major. We've obviously got the gold bid, but the dollar has sold off marginally at the moment. European equity futures, they are red. European stocks, generally lower on the day after the cash market closed, pretty much unchanged on Friday. US equity futures are down nearly 1/3%. We have had this news about the H-1B visas and the impact they might have on some of the IT workers, investment bank workers, consulting firms as well, who use these visas for basically foreign people coming into the US, which will now potentially have to pay, or will have to pay actually, $100,000 tariff, if you like, on those companies. Companies specifically, they are to employ foreign workers into the US. Otherwise, news-wise, gold, as I said, if we just grab the chart first of all, and I should say as well, if you do have any questions along the way, please do ask them. Whatever we're talking about, or of course, whatever you're looking at, always more than happy to ask any question that you want to ask. So please do go ahead and ask that in the chat box. Otherwise, here is the gold chart, pretty much one-way traffic. As you can see, up over 30% now, at least for this year. Quite stunning run, really. This is the monthly chart. And I just put this on here just because you can see for this year, we've had one very marginal month lower in July, and that depends probably potentially on the pricing that I've got here, but it says it's a very small red candle, so only 1 month down this year so far, and you can just see a great big upside breakout from this sort of consolidation on the monthly. If I look at it here, yes, sort of ascending triangle, break of that 3,400 level, then 3,500, and then off to the races in the last 6 weeks or so, 6 consecutive weeks of gains. You can see really textbook sort of upside breakout, bullish breakout from that pattern, longer term pattern. If we pull it back to the daily, and I'll just pull out, take off that. There's a lot of lines here, which I don't always like. I've got a previous high in here of 36.74, and we're off to the upside at 37.27 now. You can see again, bit of consolidation before then a break higher. This really was sort of bullish consolidation for us. And then we pushed higher, although we just pulled back to that level again. It's a classic sort of technical structure, really, and then another break to the upside. I know Goldman Sachs have 4,000 as a price target, which looks eminently possible now, even 5,000 if there's some sort of query about Fed independence, and yeah, doesn't well, that sort of story continues to play out. On the negative side, then potentially, yeah, through 4,000 for gold, and nothing much stopping it. Although you can see we are overbought on the daily, also the weekly, and also very much the monthly as well. So interesting when we do get a correction and what that might be. I think we've had more than 30 nominal record highs now in gold this year, and the latest surge really down to. Well, sorry, the latest surge, I should say, has seen now the high actually top the inflation adjusted peak, which was set in 1980. And just demand, as we always talk about it, demand for gold, obviously strong with the usual suspects, really, after this rally. Geopolitical uncertainty, I've mentioned, lingering inflation woes, potentially due to a huge debt buildup. And then also the prospect of Fed rate cuts. Obviously, we'll go through the Fed meeting from last week shortly, but potentially as well, markets looking through the near-term rate cuts at least, and potentially looking at sort of inflation picking up next year, which is actually what the Fed forecasts did project. But we'll look at that shortly, as I say. As well, central banks for us is a sort of key underpinning of gold, and the gold price have been for some months, even quite a few years now, de-dollarization, this theme playing out, we think. And then ETF inflows have recently shot up as well. So all helping gold just break to new highs. Okay, otherwise, yeah, stock wise, if I just grab a couple of charts first up, again, breaking to new highs, really. So not too much to say technically. We just look to see if they're slightly overbought. This is the S&P 500, so really the benchmark. Just a great upward channel, really. Higher lows, higher highs, and just a bullish channel. You can see really, which is sort of not as sharp as from obviously this rebound from the April lows on Liberation Day, but still pretty decent looking channel there. I'll just grab this, roughly draw on a channel. I think you'll get the picture, but let me try and make it a bit better. I have an issue with my mouse, so bear with me 1 second. You stick that sort of there and try and tap in a few of the lows, also the highs. That's not bad, and we should extend it really. And we're looking at sort of 6,700 then on the S&P, even though we are slightly overbought on the daily. On the weekly, yeah, third consecutive week of gains from last week, and we've had 6 out of 7 of the last weeks of gains. Again, pretty solid bullish channel and upside for more prices. As I mentioned, that phone call between President Trump, and Chinese counterpart Xi, that kind of supported the bulls on Friday actually. So the sale of TikTok's US operations to an American company was the main point. But then Trump said they had both made progress on a variety of issues, including trade, fentanyl, the need to bring the war between Russia and Ukraine to an end. And Trump apparently added that he would meet Xi in person on the sidelines of the upcoming Asia Pacific Economic Cooperation Summit. So, a bit of positivity for US stocks on Friday by all accounts, but we are seeing futures lower. Yeah, we got more record highs in all four actually indices. So S&P 500 is there. The Nasdaq was here again, record highs. Not too much to say. Cracking upward trend really. The Dow then. Let me grab the Dow. Sorry, that's not the Dow. Here's the Dow again. Similarly, strong close. And that is the weekly chart that we can see. But again, strong close, breaking sort of 45,000, 46,000. And we're not overbought actually on that weekly, and nor on the daily. So pretty positive. Interesting. We did also have the Russell 2000. Might not look at that too much. Small cap index that broke to record highs, first time I think in a few years, and sort of positive with rate cuts. Fed rate cuts potentially round the corner, or at least accelerated for this year. So that's stocks. Let's then move on from that to last week's main events, which of course were all those central bank meetings. First up, the Fed. I've just got a review of the numbers. We did this graphic before the Fed as a preview, and now we've just got a review, left a couple of numbers, but updated it as well. They obviously cut rates by 25 basis points, quarter point rate cut as expected, to leave the range at 4 to 4.25%, after keeping it stable actually at 4.25 to 4.5 since the start of the year. But there were kind of mixed messages really. If we start with the numbers, so we had, of course, an updated dot plot and summary of economic projections. So for those, the central bank raised the growth path over the policy horizon. That's 2025 to 2027. Expectations around unemployment shifted as well, lower. And then headline core and PCE deflators, so inflation, were projected at 2.6% next year instead of 2.4%. So summarizing that, stronger growth, lower unemployment, higher inflation. And you kind of think, without sort of any additional context, then that kind of certainly doesn't call for a rate cut, and possibly calls for raising the Fed funds rate, typically. But that's not what we got. And indeed, actually, Fed Chair Powell labeled the rate cut as a risk management decision. Really interesting speak from him. And also with those forecasts, we got the rate cut as expected, but then the forecasts really weren't that much expected, with those three sort of key metrics all pointing, growth pointing higher, inflation higher, as I said, and lower unemployment. Compared with the July policy statement and in line with the pivot made by Powell at Jackson Hole, of course, the Fed now judges that downside risks to employment have risen in light of that shift in balance from kind of attentive to the risks to both sides of its dual mandate. Basically, the Fed and officials almost unanimously decided to lower the Fed funds rate versus sort of bigger dissent that was expected. So again, that was an interesting call, because potentially we thought that Waller and Bowman may back a bigger cut, but they didn't. The only person who did that, of course, was the Trump very recent appointee, Mirren, of course. And it kind of all points, to a stronger signal, a strong signal even, that from within the Fed, all the governors, then they backed Powell, and they pushed back against any political attempts to manipulate, of course, the independence of the Fed. Interesting stuff, really interesting stuff when you look at it. As I said, Fed Governor Mirren, he voted for a 50 basis point cut, and we'll get on to him actually. He's only a temporary appointment, but really interesting along again, I think, with this independence question, and how somebody can be voted on the committee for only a few months, who votes against the tide really, but then also votes for jumbo rate cuts in the next few months. If I look at the dot plots then as well, the median estimate for the end of year Fed funds rate now stands at 3.5 to 3.25. That's down from 3.75. Sorry, it's 3.5 to 3.75. That's down from 3.75 to 4% that was seen in June. And then it's interesting again with the split between the governors. I should have put in the dot plot chart here, but sometimes it doesn't make too much sense. But the split between the governors was interesting. So 9 out of 19 say there should be maximum one rate cut this year, whereas just 10 out of 19 think there should be at least two 25 basis point cuts this year. And of course, in amongst that 10 is Mirren, as I've said, who suggested an additional 125 basis points over the next two meetings. So kind of kind of unseen really how I can't explain it really. I was reading it over the weekend about Mirren, just a temporary appointment who comes in, votes for a 50 basis point cut, then votes for another 125 basis points over the next two meetings, completely against all the other governors, and it's a very short term appointment, and how you cannot say that's not political is an interesting question, shall we say. Going forward, I need to move on from this. It's telling really that the press release didn't hint at a continuation of gradual rate cuts if things play out as expected. So it kind of all suggests a data dependency and kind of this sort of meeting by meeting approach, which is what we've seen in the ECB, for example. Given, though, of course, we should say the new risk assessment about the labour market, then kind of any disappointing job market data likely carries basically a bigger weight than upward inflation surprises. And just take that. We'll keep that in mind, of course, with the PCE data, of course, where the markets look through that because we're completely now focused on labour market data. So, for example, the weekly initial jobless claims data that we get on a Thursday, again, may prove interesting going forward because the Fed is looking at employment data much more than inflation now going forward. Just on as well, just a couple of other points. Kind of don't draw any conclusions from any of the median policy rate estimates for next year and the year after. Very well, I should say, just slightly unreliable as to what actually does happen for some of those 26, 27, certainly 27, 28, quite far out and not that reliable for what is going to happen with policy. Markets then they interesting again. They sort of they reacted dovishly straight away, obviously with this median 2025 estimate confirming scenario of two more 25 basis point rate cuts this year. So October, December, as we've got, and we've got around just under that now because we've had this sort of bounce back in Treasury yields, so a sell-off in bonds and a bounce back in the dollar. So around 44 basis points at the moment for the next two meetings, October, December, that is, for the Fed. So we had that initial reaction, dovish reaction, but then after that, things changed. Euro-dollar made a fresh year-to-date top, but then has fallen quite sharply since that 119.19 high there. I'm just checking where euro dollar is now, just below 118 now, actually. And US Treasuries, as I said, changed tack as well. So bonds were going higher, but then sold off and have sold off the last few days. So yields have gone, sorry, bonds went lower, yields went higher. And that's what we've seen over the last few days. Yeah, that's kind of the main points and some of the conclusions, really. Potentially lines up quite a volatile year end as we're very data dependent now, or very employment data dependent, I should say, and especially with this meeting by meeting approach. Fed speakers, of course, will be key. I was going to mention them earlier, later on, but yeah, we do get a lot of Fed speak actually this week. So keep your eyes, ears open for any comments to see really whether Powell's cautious tone on the need for more cuts is shared by the majority of the FOMC. Just on today, actually, we get a few speakers, Hammock, Muslim and Barkin, and also John Williams, who's more of a dove. And also apparently Stephen Mirren as well, who obviously voted for those jumbo cuts. I think Chair Powell actually also speaks tomorrow. So yes, lots of Fed speak out this week. Will be interesting to see their views against what we just talked about from the Fed last week. Just a few charts showed you last week, of course, just the NFP. What was expected 78, we got 22,000, of course, on the headline. And that's where concerns are now focused. Then we've had the unemployment rate tick up, obviously, and you can just see that high from 4.5%. Back in 2021, and then just another chart on that CPI again, less important now potentially going forward, as I've said. Okay, let's just jump onto the DXY actually now, which is obviously the dollar index chart. As I said, it's a dollar against 6 of its major trading partners. With the euro by far the biggest weighting, around 56%. So you can just see, really interesting, that move. Let's expand this on Wednesday. So we dipped down to a fresh multi-year low at 96.21, but then closed higher on the day, you can see, and that's why we've got, the low from July. That's at, where was it, 96.37, sorry. So this looks like very strong support now at the moment. And if I just pull it back, actually, this long dotted line here, upward trend line from lows in 2011, 2021, and again this year. So just pulling that in again, you can see we dipped below it, but bounced off it again. So interesting trend lines here and sort of zone of support, if you like. Above here, you've got the blue line, 50-day moving average. That's a 98.07. And then the 100-day as well, cap the upside, the grey line, that's a 98.45. And really, I should move these fib levels now a touch lower to that low from Friday of 96.21.8. So bear with me 1 second. Let's just update this, and you can see the first minor fib level around previous low, actually at 99.51. If I just pull it back here, it's a low from from July 2023. Pretty big swing low there. So that capped the upside previously. So that is major resistance at 99.51 on the dollar index. Okay, moving on to the Bank of Canada. Just got a chart for this, used it last week, but really interesting, showing unemployment rates creeping higher above 7% now. That's the orange line. And then you've just got the employment change with a negative number most recently. After pausing since April, actually, the Bank of Canada, they did cut rates as expected by 25 basis points to 2.5%. They basically said further weakness in the economy after growth contracted by about 1% in Q2. Was needed as exports and investment heavily weighed on growth. Employment recently declined, mainly due to job losses in trade-sensitive sectors, but job growth also slowed in the rest of the economy as well. Officials, they expect slow population growth and weakness in the labour market to weigh on household consumption in the months ahead. And then on the inflation side, CPI, that was at 1.9% in August. And measures of core inflation were near 3%. But the Bank of Canada, remember, assesses underlying inflation, which is closer to 2.5%. But really, the combination of weaker growth, employment, less upside inflation risks justified the rate cut. They will have to proceed carefully. I think that's for the words they used, actually, the MPC there, with particular attention to risks, obviously, and uncertainties, without giving concrete guidance on the next step or steps. Markets, they still discount a final rate cut by early next year. So let's just put up dollar CAD, actually, which is here, it's been fairly range bound actually, and this is what we put in our daily preview of the Bank of Canada. We had in here, and we suggested there could be a sort of bearish reversal head and shoulders pattern. You can see it there with the neckline there, but we didn't quite break it. We sort of bounced off that neckline really. You've got the 100-day and 50-day moving averages as well, offering support potentially. So then we've got this high from earlier on in September at 138.92, and then that high from late August at 139.24. Shame it didn't play out, but often these sort of textbook classic patterns, can sometimes struggle as well. So that was the Bank of Canada. We also had the Bank of England. Just bear with me again. I've got a slide to show you, which just has inflation rates and the benchmark rate. Bank of England, they left the bank rate on hold at 4%. Pretty much as expected. Issues, of course, are all centered on inflation being sticky and elevated. The vote was 7-2, pretty much as expected, actually. So 7 for a hold, 2 for a cut. That was the usual suspects, Taylor and Dingra. They maintained the bank or the MPC, their guidance, which is what we fully expected, of a gradual and careful approach to further withdrawal of monetary policy restraints. That remains appropriate. Interesting, they did slow the pace of quantitative tightening actually to $70 billion annually from 100 billion, again close to expectations. So it didn't really move the gilt or sterling. And it's whether then they stick the MPC to a sort of quarterly rate of, or quarterly pace of cuts, really, is what it is. That would mean November, which is in line with when we get the monetary policy reports, the MPRs, which are quarterly. There's around 7 basis points of rate cuts priced in for that November meeting, so around a sort of 28%, 30% chance of a cut only at the moment. Much probably depends, as I said, on CPI data, and certainly we get the the September CPI report on the 22nd of October. So before the early November, I think it is, Bank of England meeting. That will be crucial, really, to see any progress on disinflation, really, any downside risks to activity. There was a lot of stressing really about their concern about sticky inflation, and by all accounts, that will tick up potentially to high 3%, if not 4%, which then would really put in doubt that November rate cut and then this quarterly pace of cuts, which we've obviously seen and have been expecting to carry on going forward. So just watch out for that date in a few weeks' time, actually. But of course, we'll get other UK data before that as well, just to look at. Otherwise, one other central bank meeting, how are we getting on for time? We're good, which was obviously the Bank of Japan. Here is a dollar-yen chart. Just before I get to that, then, before the Bank of Japan, actually, we had Japanese August inflation data, excluding fresh food, which is basically the Bank of Japan's favorite metric. That eased actually below 3% to 2.7 from 3.1, actually due to utility subsidies. The core measure additionally excludes energy. That dropped only slightly, actually, from 3.4 to 3.3. So both those measures firmly above the Bank of Japan's 2% target. And then obviously we had the Bank of Japan meeting and the policy decision. They left rates unchanged at 0.5% as expected. But it was supported, very interestingly, by a hawkish vote of 7-2, with notably 2 members voting for a 25 basis point rate hike. There was no outlook report for this meeting, so it was kind of a small meeting, an unchanged guidance. But also on the hawkish theme, the Bank of Japan announced it will start to sell ETFs and real estate investment trusts J-REITs meeting three principles, including that it should avoid inducing destabilizing effects on financial markets. But that was an interesting sort of potential move for more policy normalization, essentially. We still have a solid growth picture. Real wage growth is back in positive territory. So potentially then the conditions are lining up for a rate hike in the October meeting. That decision as well, that's when we get forecasts and outlook as well. So it could be as well supported by an updated growth and inflation, as I say, outlook. Markets pricing in around 12 basis points, I think, for the October meeting of hikes, and a bit higher than that for year end, around 19 basis points by year end. So yes, looking potentially possible for October, a rate hike. We just have to caveat that with the fact that we do get the potential snap election, possibly in the wake of then the LDP election, leadership election, which takes place takes place on the 4th of October, and could also end up postponing that rate hike potentially to December. Depends who gets in, obviously. Koizumi and Takaichi are the main candidates, I believe. Really quite different from each other. Takaichi, fiscal and monetary policy concern there, and potentially she delays rate hikes, which is not in support of. Koizumi is different. So yes, will be interesting to watch those polls really for who is inching ahead, moving ahead in the LDP leadership election. And again, that takes place on the 4th of October. So we'll be watching the polls ahead of that. After the Bank Chuan meeting, we did get that sell-off. You can see in the yen, actually, just sorry, not in the yen, in dollar yen. So the yen strengthened actually, and 2-year yields actually, they jumped initially to their highest level since 2008 on expectations really of this front loading of a potential further rate hike. But then we've seen sort of in dollar yen anyway, bit of dollar strength over the last few days, and that has, and also treasury yields actually, I should say, pushed higher, and that has meant dollar yen stabilizing. You can see the black line here is the 200-day moving average. That's at 148.55 there, capped the upside previously, so could be decent resistance. Blue line, where we're trading around 50-day moving average at 147.68. If I just you can see the levels here, and the 32 of this move lower, that's at 7. And then you've got the 100-day low here at 146.67. Okay, moving on from last just to this week, you get a bit of data, PMI data along with PCE, and all of those Fed speakers that I mentioned. There are other speakers as well, central bank speakers, that is. So in the UK, and chief economist Pill speaking today. Not sure when, so I need to check that. ECB, we get Lane and Nagel speaking as well. So yeah, just watch out for those. PMI data, as I say, the most important probably data on the Eurozone, especially, and the UK. This really measures the health of business activity. So in Europe, yeah, these figures all come out tomorrow, actually, and preliminary estimates for the September numbers should show further improvement in the manufacturing sector and stabilization in expansionary territory for services. Manufacturing actually predicted to tick up slightly from 50.7 to 51.0. Services seen stabilizing just above that 50 sort of boom bust level, expansionary contractionary level at 50.5. So both gauges are in expansionary territory, but growth is still relatively weak, with especially services kind of being a little bit patchy and uneven now. It should also give us more clarity, the data, on the impact of US tariffs, of course, following a mixed picture from recent figures. Certainly, though, if confirmed, the PMI figures above 50, then that sort of tallies with the ECB's relatively optimistic economic outlook after they left rates unchanged at 2%, of course. And the Governing Council on the ECB, they've been relatively quiet this week. Or recently, sorry, although we do get, as I said, several speakers this week. So that's the Eurozone, and this is, sorry, a really good matrix, with blue being above 50, red being below 50, red contractionary territory, and blue obviously expansionary territory. UK PMIs as well, always looked at as well. They're out on Tuesday, following obviously that Bank of England decision to leave rates steady. Company concerns probably over the prospects of tax rises, which have been very headline worthy in the UK, and the highest inflation among advanced economies, really. That should remain, even though services grew by the most in the year, over a year actually, in August. Manufacturing expected to slide to 46.9 from 47 due to fragile demand. Services also expected to dip, though, from 54.2 to 53.9. Then the rate of expansion in the composites, which hit a one-year high, that might dip slightly, although growth was seen pretty decent or steady actually over the summer in the UK. Okay, we also get US core PCE data. As I said, that's out on Friday, the Fed's favored inflation gauge, and that is likely to rise, I think, 0.2% month on month, 2.9 year on year. The Fed's most recent medium forecast saw a reading of 3% actually by the end of 2025, but then cooling to 2.6 next year from the prior 2.4, and then they maintained it at 2.1% in 2027. That forecast, the medium forecast. As I've mentioned, though, they have pivoted the Fed towards the employment side of the dual mandate, and so just bear that in mind, of course. And then potentially for core PCE, we may get a pickup from September to December as a result of tariffs. So that'll be a focus going forward. Finally, let's get to Aussie data. Actually, we got the S&P as well. Let me first grab the Aussie chart just quickly, which is here. You can see, so yeah, we do get Australian inflation out on Wednesday. That comes ahead of the, next Tuesday's RBA meeting, actually, where officials are expected to stand pat on rates. Investors, policymakers, yeah, we will be hoping really that the latest inflation figures show some signs of easing after July's surprise 2.8% above forecast headline reading, but that followed a surge in electricity prices. I think those potentially may be reversed, and some of the seasonal travel pressures as well may fade. Yes, likely possible a softer CPI print. And we've also had a gradual cooling in the labour market, actually, with unemployment unexpectedly falling while the jobless rate held steady. Sorry, employment unexpectedly fell while jobs rate held steady. That should mean the RBA is cautious. And I think the Assistant Governor Hunter said recently the economic outlook is balanced with risks on both the upside and downside. So a pause from the RBA. As for the Aussie dollar, did tick up quite nicely actually to that multi-month high, up to, where was it in the end? 67.07 actually, and we haven't seen that level since sort of October of last year. But then we were slightly overbought, you can see, and we were just pushed back down, back into this sort of range of range trading that we've seen over the last few months, really. So whether we can hold here around these highs from sort of end of July and mid-July, that's just below 66. And then you've got probably stronger support around the major fib level of this move lower at 65.49. Finally, S&B quickly. We'll look at the dollar Swiss chart, which is here. S&B, yeah, a meeting on Thursday, not expected to change rates, so keep them at 0%. Basically, officials have indicated the bar is very high towards putting or cutting rates into negative territory. That is as well, according to the S&B chairman, even in light, of course, of the headache caused by a strong Swiss franc, which is what we've seen over the last year. Year to date, actually, the Swiss has rallied around 15% against the dollar from these highs up towards 92. We're now down below 80 on dollar Swiss. And it's probably set for its largest gain since I think around 2002. So big gains for the Swiss franc, bit of a headache for the S&B, and certainly chart-wise, you can just see that with dollar Swiss going lower. Yeah, bit of a headache, as I say, for the S&B, and just checking that. Yeah. Currency strength, of course, is an issue for some of the big Swiss exporters like Richemont and Novartis and Nestle. That sort of may add to, currency strength adds to hefty US tariffs as well. Inflation in Switzerland has picked up recently, which could give the S&B more wiggle room to do nothing actually for now. That means kind of we need stronger evidence for softer or cooler prices. And many analysts I know do expect that we're now actually at the terminal rate, in the Swiss Swiss interest rates essentially. Dollar Swiss, you can see here. We dipped to a multi-year low at 78.28. If I just pull it back slightly. We haven't touched that level since, you can see 2011 actually. So very long multi-year low there. You can just see on the weekly chart, interesting sort of possible bullish candle, reversal candle there. Depends what we do this week, whether we can move up beyond those spike lows on the week at least. We've got the 50-day moving average, that's at 80.14, which sort of capped the upside. Otherwise, the 100-day just above that at 80.85. Okay, covered quite a lot there, actually. Hope that's proved of use to you guys. Really do appreciate you being on the call for all this time, and also, of course, tuning in. Please do follow us on social media, and we do put out a commentary on the website every day after the US close, looking at the dollar, US stock indices, a preview of the day ahead, and also a chart of the day. So do please look at that if you can. Really appreciate you being on the call, and we will be doing another one same time next week.